There is a specific kind of nausea that settles in the pit of your stomach when you witness the destruction of wealth on a scale that defies logic. It is not the sharp, sudden pain of a physical injury. It is a cold, creeping realization that the ground you were standing on, the ground you were told was solid rock, was actually a trap door. If you are watching this, you are likely sitting in the aftermath of one of the most brutal 48 hours in the history of the precious metals market. You are looking at a screen that is painted in a shade of red so deep and so violent that it feels personal. You watched silver collapse 25%. You watched gold shed 8% in a heartbeat. And you are left with a silence in your home and a noise in your head that is asking the same question over and over again. Was I wrong? Was the thesis a lie? Is this the end? We need to have a very difficult, very honest conversation about what just happened. This was not a correction. This was not a healthy pullback. This was a liquidation event. This was the red button moment. It was the moment when the invisible hand of the market balled itself into a fist and punched the collective face of every retail investor who dared to believe that they could protect their wealth outside of the system. But before you panic, before you sell the bottom and crystallize those losses into a permanent scar on your financial future, you need to understand the mechanics of the machine that just ran you over. You need to understand that what looks like a conspiracy is often just physics, brutal, unforgiving, leverage-fueled physics. To understand this crash, we have to strip away the emotion and look at the anatomy of the collapse. It started in the shadows. It started not with a headline, not with a war, not with a declaration from a central bank, but with a whisper in the plumbing of the financial system. We saw a synchronized, simultaneous air pocket hit the markets in New York, in London, and in the electronic exchanges of Asia all at once. Gold did not just drift lower, it was slammed. Silver did not just slide, it was pushed off a cliff. When you see assets move in lockstep like this, when you see the correlation between gold, silver, miners, and even crypto go to one, you are not seeing selling, you are seeing liquidation. There's a profound difference. Selling is a choice. An investor looks at the price, decides it is too high, and sells to take a profit. Liquidation is not a choice. Liquidation is a gun to the head. It is a margin clerk at a prime brokerage computer hitting a button that sells everything in a portfolio because the collateral has dropped below a critical threshold. What we witnessed yesterday was a global margin call. It was a leverage flush. It was the market hunting for liquidity in a desert and finding it only in your stop losses. The concept of the red button is a metaphor for the algorithmic kill switch. In the modern marketplace, humans do not set prices. Machines do. Algorithms that are programmed to detect volatility. When the price of silver began to accelerate to the downside, it triggered a volatility event. These algorithms are risk-averse. They are not programmed to buy the dip, they are programmed to survive. When volatility spikes beyond a certain standard deviation, the algorithm hits the red button. It sells. It goes to cash. It doesn't care about the long-term fundamentals. It doesn't care about the debt ceiling. It cares about variance. And yesterday, the variance was too high, so the machines puked the positions. This created a feedback loop, a cascade. The first machine sells, which pushes the price down. This triggers the stop-loss orders of the retail traders who were chasing the momentum. Those sell orders push the price down further. This triggers the next level of algorithmic selling from the trend-following funds, CTAs. They see the trend flip from up to down, so they flip their massive positions from long to short. This adds fuel to the fire. Suddenly you have a 25% drop in silver in a matter of hours. It is mechanical, it is mathematical, and it is terrifying if you do not understand that it has nothing to do with the value of the metal in your safe. Let's talk specifically about why silver fell 25% while gold only fell 8%. This is the curse of the high beta. Silver is gold on steroids. It is the sports car to gold's armored truck. When the road is smooth, the sports car is faster and more fun. But when you hit a pothole, the sports car spins out and crashes into the guardrail, while the armored truck just feels a bump. Silver is a tiny market. It is a thin market. It does not take much capital to push it around. When the liquidity dries up, the bids disappear. Imagine you are trying to sell your house during a hurricane. It doesn't matter that your house is made of brick. It doesn't matter that it has a new roof. If everyone is evacuating, there are no buyers. You could drop the price 50%, and you still might not find a buyer until the storm passes. That is what happened to silver yesterday. The bids evaporated. The market makers stepped back. They widened their spreads. They said, "We are not catching this falling knife." So the price had to fall all the way down to the level where the deep value institutional money was waiting with a bucket. And that level was 25% lower. The danger now is the narrative. The human brain craves a story. We see a crash and we want a villain. We want to say, the banks manipulated it. The government smashed it. And while there is always an element of management in these markets, relying on the conspiracy theory is a trap. It makes you a victim. It makes you passive. If you believe the game is rigged against you and you can never win, then you will sell. You will leave. And that is exactly what the smart money wants. They want your ounces. They want to buy your panic. If we look deeper into the mechanics, we have to talk about the options market. This was a gamma flush. I know that sounds technical, but stay with me because it is the key to the mystery. When investors buy call options, betting on the price going up, the banks who sell those options have to hedge. They hedge by buying the underlying futures contracts. As the price goes up, they have to buy more. This accelerates the rally, but it works in reverse. When the price starts to fall, the banks have to sell their hedges. They have to sell futures. And the lower it goes, the more they have to sell. This creates a magnet effect. As the price dropped yesterday, it was pulled down by the gravity of these option dealers unwinding their positions. They were not selling because they hated silver. They were selling to stay delta neutral. They were balancing a mathematical equation. You were the collateral damage of that equation. Understanding this empowers you. It tells you that the drop was artificial. It was a derivative event, not a fundamental one. The silver atoms did not change. The industrial shortage did not change. The mine supply did not increase. Only the paper bets changed. Now we must address the tourist problem. Over the last 2 weeks, as prices soared, a new group of investors entered the market. We call them tourists. They are the people who buy because they see a green line on a chart. They do not understand the history of money. They do not understand the Federal Reserve. They just want to get rich quick. These tourists used leverage. They borrowed money to buy silver. They bought call options that expire in a week. They were all in. The market is a cruel mistress. It cannot tolerate a crowded trade. When everyone is on one side of the boat tips over. The crash yesterday was the market tipping the boat to wash the tourists overboard. It was a cleansing. It was a purge. The leverage has been wiped out. The people who bought on margin have received the dreaded call from their broker, deposit more cash or we sell your position. They didn't have the cash, so they sold. This transfer of ownership is painful to watch, but it is bullish for the long term. You cannot build a skyscraper on a foundation of sand. You cannot build a sustainable bull market on a foundation of leverage. The leverage had to go. Now that it is gone, the market is lighter. It is cleaner. The weak hands are out. The strong hands, the stackers, the central banks, the industrial users are still there. They didn't sell. In fact, they probably bought more. But here is the warning. The danger is not over. The most dangerous moment in a crash is not the fall. It is the first bounce. We call it the dead cat bounce. After a violent drop, the price often snaps back quickly. It looks like a recovery. The tourists who survive the first wave think, okay, the bottom is in, let's buy again. But often, this bounce is a trap. It is shorts covering their profits, not new buyers entering. Once the covering is done, the market rolls over and tests the lows again. We need to see stabilization. Do not look for a V-shaped recovery where the price shoots straight back up to the highs. Look for the market to stop going down. Look for the volatility to decrease. Look for the price to chop sideways. This boring sideways action is the market healing. It is the market building a floor. Buying a falling knife is gambling. Buying a floor is investing. You must have the patience to wait for the floor. Let's zoom out and look at the macro landscape, because that is the anchor in this storm. Why are we here? Why are we holding precious metals in 2026? Has the United States government balanced its budget? No. Has the national debt stopped growing? No. It is accelerating. We are adding $1 trillion of debt every few months. The interest payments on the debt are now larger than the defense budget. The system is mathematically insolvent. This crash in silver and gold does not fix the debt. It does not fix the bond market. It does not fix the geopolitical fractures. In fact, it makes them worse. A lower silver price discourages mining. It means less supply in the future. It exacerbates the shortage. The fundamental thesis for owning gold and silver is that the fiat currency system is in the end stages of a collapse. Nothing that happened yesterday changed that thesis. In fact, one could argue that this volatility is a symptom of the collapse. When a system breaks, it does not break linearly. It breaks chaotically. We see massive swings up and massive swings down as the market tries to find a price for money that no longer has any value. The volatility is the death rattle of the dollar system. We also need to look at the divergence between the paper price and the physical price. This is the ultimate tell. While the screen price crashed yesterday, try to go out and buy a monster box of Silver Eagles at the new spot price. You will likely find that the dealers have raised their premiums. They are not stupid. They know that the paper price is detached from reality. They are not going to give away their metal just because a computer in Chicago had a meltdown. If you see the spot price drop, but the physical price stays high, that is a signal. It means the physical market is tight. It means the supply chain is stressed. It means that the paper crash is an illusion. We are moving toward a world where the paper price becomes irrelevant. A world where the only price that matters is the price you pay to put metal in your hand. This bifurcation is already happening. The East, China, India, Russia, trades physical. The West trades paper. The West is selling paper to the East, and the East is taking delivery of the real thing. This brings us to the geopolitical dimension. We know that central banks around the world have been buying gold at a record pace. Do you think the People's Bank of China panicked yesterday and sold their gold because the price dropped 8%? No, they view this as a discount. They view this as a strategic opportunity to de-dollarize faster. They are playing a century-long game. We are playing a week-long game. We need to extend our time horizon. If you are losing sleep over this crash, it means one of two things. You are over-leveraged, or you do not understand what you own. If you own physical gold and silver, you own the only financial asset that is not simultaneously someone else's liability. If you own stocks, you rely on the company's earnings. If you own bonds, you rely on the government's tax receipts. If you own cash in the bank, you rely on the bank's solvency. If you own gold, you rely on nothing. It is sovereign. It is yours. The drop in price does not change the weight of your stack. An ounce is still an ounce. The only thing that changed is the exchange rate between your real money, gold, silver, and the fake money, dollars. And since the fake money is managed by people who have a vested interest in destroying its purchasing power, the long-term direction of that exchange rate is mathematically guaranteed. But let's be practical. What should you do right now? First, turn off the screen. Staring at a red chart triggers the flight or fight response in your brain. It makes you irrational. It makes you want to do something, anything, to stop the pain. Usually that something is selling at the bottom. Step away. Go for a walk. Realize that your life has not changed. Your family is still there. Your health is still there. Your metal is still there. Second, assess your liquidity. Do you need cash this week? If you need cash to pay rent and your savings are in silver, you are in trouble. You are a forced seller. Forced sellers get eaten by the market. This is why we always say, keep a cash buffer. Cash is trash in the long run, but in a crash, cash is oxygen. It allows you to breathe. It allows you to not sell your assets at a discount. If you have cash on the sidelines, this crash is not a tragedy. It is an opportunity. It is a time machine that lets you buy at prices from last month. Third, audit your leverage. If you survived yesterday with margin positions open, consider it a warning shot from the gods of finance. Deleverage. Reduce your risk. You do not need leverage to get rich in a bull market like this. The underlying asset will do the work for you. Leverage just introduces the risk of ruin. The goal is to survive. If you survive, you win. We also need to talk about the trap of certainty. Many influencers and analysts have been screaming that silver can only go up. The shortage is here. The COMEX is empty. While the long-term trend is up, the short-term reality is brutal. Certainty is dangerous. The market loves to punish certainty. It loves to humiliate the arrogant. When everyone is sure that a crash is impossible, that is exactly when it happens. We must remain humble. We must respect the market's ability to remain irrational longer than we can remain solvent. Just because the COMEX inventories are low does not mean the price cannot drop. The paper market is a beast with its own logic. It can trade billions of phantom ounces to suppress the price. We have to acknowledge this reality, not deny it. We play the game as it is, not as we wish it to be. The red button moment was a stress test. It tested the plumbing of the exchange. It tested the solvency of the brokerages. But most importantly, it tested your conviction. Why did you buy silver? Did you buy it to make a quick buck in a week? Or did you buy it as insurance against the collapse of the sovereign debt bubble? If you bought it as insurance, then the price drop is irrelevant. You don't cancel your fire insurance because your house didn't burn down today. You keep it because you know the wiring is faulty and the house is made of wood. The house of the global economy is burning. The fire is the debt. The smoke is the inflation. The crash yesterday was just the roof caving in on one room. It doesn't mean the fire is out. It means the structure is weakening. I want you to imagine the perspective of the big banks right now. The JP Morgans, the Goldmans. They made a fortune yesterday. They saw the order flow. They knew where the stop losses were. They triggered the avalanche and then caught the falling rocks at the bottom. They are not panicking. They are celebrating. They just acquired massive amounts of inventory from retail investors at a 25% discount. Do not give them your inventory. Do not participate in the wealth transfer from the poor to the rich. Hold the line. This is what it means to be a stacker. It is easy to stack when the price is going up every day. It is easy to be a genius in a bull market. But the real stackers are forged in the fire of correction. They are the ones who look at a 25% drop and don't blink. They are the ones who know that volatility is the price of admission for the massive gains that are coming. The next leg of this bull market will be built on the despair of the people who sold yesterday. The market climbs a wall of worry. It needs people to be skeptical. It needs people to be scared. When everyone is scared, there is no one left to sell. And when there is no one left to sell, the only direction is up. We are washing out the weak hands. The weak hands are the people who bought with rent money. The weak hands are the people who thought this was a crypto coin that would go up 100x in a day. They are gone now. Good riddance. Now the market can stabilize. Now the real accumulation can begin again. As we look forward to the coming week, expect volatility to continue. The aftershocks of a quake like this last for days. We might see another test of the lows. We might see a fake rally that fails. Do not try to be a hero and day trade this mess. Sit on your hands. Let the dust settle. The true direction will reveal itself once the liquidity returns to the market. Remember the fundamental equation: demand supply, higher prices. This equation has not changed. The mines are still depleting. The grades are still falling. The world is still electrifying. The deficit is still growing. Physics will win in the end. Paper games can distort reality for a moment, but they cannot change the laws of nature. The red button stopped the rally, but it did not kill the bull. The bull is just catching its breath. It is shaking off the fleas. It is getting ready to charge again, and when it does, it will leave the sellers in the dust. You have a choice today. You can be a victim of the algorithm, or you can be a master of your own psychology. You can succumb to the fear, or you can stand on the bedrock of your conviction. The crash was a test, a brutal, unfair, violent test, but if you are still watching this, if you are still holding your position, you passed, you survived. And in this game, survival is the only thing that matters, because if you survive the crash, you get to participate in the inevitable, mathematical, unstoppable rise that comes after. The red button was pressed. The explosion happened. We are still standing. Now we rebuild. Now we accumulate. Now we prepare for the next chapter. Because the story of gold and silver is not over. It is just getting interesting. Stay strong, stay solvent, stay disciplined. The best is yet to come.